Okay, excellent. Right, good morning, everyone. Just a quick recap of last week. Very, very quiet week on the whole, actually. Just as you can see, I'm looking at the S&P here up. Just consolidating, really, since that breakout 10 days ago, above that 2134. Not a huge week, really, for the S&P, only gaining some 20 points. But to me, it looks like it's just trying to get comfortable, really above these levels. Obviously, some bigger tests to come this week. Out of the ECB, we didn't really see any major change. There was nothing really to get too excited about on that front. So really, we all turn to this week.
With European markets now firmly open, give a quick one.
So just looking ahead to this week, really, I think a lot of the action that we saw, particularly looking at that euro, which, as Anthony's pointed out, was stuck in the tightest range since December 2014, really. So just highlighting what a kind of week of consolidation it was. And oil, interestingly, oil had another really weak on the whole, another red week, and that's very quietly corrected some $7 or $8 in the past couple of months. But obviously that correlation with equities is not so strong as it was at the start of the year, or indeed last year, when basically crude oil and the S&P moved pretty much in lockstep. And I think that's because, we've already had such a decent rally here in crude. And secondly, I think a lot of the story at the moment, a lot of the reason why equities are staying so nicely bid is all about central banks. And on that note, we've got a couple of key central bank meetings this week, which I will discuss shortly. But firstly, from the news over the weekend, not too much in terms of the G20, which was held in China. Again, more lip service towards promoting global growth, particularly from the Chinese, who are the hosts. But again, not a major one in terms of news flow. But there was certainly an interesting article in The Guardian, which caught my attention. Looking at, I'm just going to drag it up here on the screen, if you just bear with me. And as you can see from the headline, it's quite surprising, really, that apparently these are very, very early stage talks, so to be taken obviously with a pinch of salt. But the EU is considering an emergency break for the UK for up to 7 years, while giving the UK, while the UK can retain access to the single market. So this is certainly a better deal that could be expected from the UK. Following the Brexit vote, and probably, although it is very, very early days and there's no formal talks, obviously both parties have said, well, certainly Theresa May has said we're not going to invoke Article 50 of the Lisbon Treaty until next year, and we've had very mixed picture from the Europeans, with Holland last week saying, could the UK quickly come to the table and negotiate so we can end this uncertainty, whereas Merkel striking a more conciliatory tone and saying that she understands our wish to wait a bit longer. But certainly this is quite interesting from that point of view, and it would be an excellent deal for the UK. And perhaps, if it is true, again, source comments, nothing more than that, if it is true, would certainly speak perhaps as to how concerned the EU are that this exit by the UK could lead to perhaps some contagion from other European countries. So they're probably keen to give us quite a good deal, I suppose, because they're concerned about us exiting and the disintegration of the EU. So these talks really very, very important for both sides in terms of the future of the European Union and of course what the UK gets out of it. But anyway, early signs are, if this Guardian article is to be believed, that there may be an emergency brake for the UK for up to 7 years from the freedom of movement of labour. And as we know, that was one of the key reasons why the Leave camp won, to try and control the movement of migrants from particularly Eastern European countries into the UK. And so this would certainly help perhaps satisfy some of the leavers. So in terms of this week, very, very busy week. I'm just going to get out this highlights package really. As you can see, it is notable for perhaps a couple of things in particular. I was talking about central banks and the BOJ on Friday. I'll start with them, even though we have obviously the Fed statement on Wednesday. Just looking at the BOJ, firstly, we had exports overnight falling for the 9th consecutive month in Japan. That's on a year-on-year basis, and imports as well, I think, falling for the 18th consecutive month. So very, very weak economic picture in Japan. And significantly, perhaps more significantly, Abe won the re-election on the 11th of July. And so he has a very, very strong mandate to go on and continue with his Abenomics, his policy of trying to devalue the yen and boost those exports, generate inflation, and restore the Japanese reputation as an economic powerhouse. So far, he hasn't had much success, and that's because it's mainly focused on monetary policy, monetary stimulus. But there are signs that. Hang on, if I just get this up, I'm just going to get up a look at what Nomura are looking at. There are signs that for the first time he's going to turn to more towards fiscal policy. So although we have the BOJ meeting on Friday morning, which will be announced before you arrive at your desks, and they're announcing, perhaps, this is Nomura's view, an additional purchases of ETFs and REITs to the tune of 180 billion yen a year for the REITs, and an additional to 6 trillion yen a year of ETF purchases, and negative rates potentially on current loan support programs, and the IOER cut further into negative territory. These are not likely to gain the market's full attention because we are expecting a stimulus package, a fiscal stimulus package from Abe. And this would be the first time that basically it's notable because it suggests that he's moving away from monetary policy and suggesting that the limits of monetary policy for Japan have been reached, and that now it's time to go another way. And given that the Japanese central bank tend to lead the other central banks in terms of their policies, this is quite an interesting defeat, really, for the Bank of Japan. So all eyes really will be on the fiscal package likely to be announced, although the BOJ meeting is also on the Friday. We suspect that they'll be announced at the same time, kind of a twin-pronged approach. So just having a look at this, I've got the yen here, looking at dollar yen. Obviously you can see the election win on the 11th of July, and since then the yen has really powered higher above that 106 handle. And looking at the Nikkei, if I just get that up, also rebounding very strongly. So to invest in the Nikkei, to me, is all about, basically it's a currency play. It's a proxy for a currency. Either they weaken the yen and that strengthens Japanese exports and strengthens the value of Japanese corporate earnings when they convert from dollars into the yen. So much in the same way that a lot of the gains that we've seen in the FTSE 100 have been down to pure currency play as sterling is devalued, and that boosts obviously the dollar denominated exports earnings of a lot of the big UK corporates. It's a very similar picture with Japan. So if the Nikkei, if the yen can continue to climb higher, lower, can continue to weaken against the dollar, then the Nikkei can continue to strengthen perhaps. Being stuck in this range, really quite a big range between 18,000 and 15,000, a bit of a double bottom emerging from the Feb low and the June low here. So definitely room for the Nikkei to go higher, but again that depends on what the market's view of the stimulus package is likely to be. We got a further boost last week to risk assets when it was perhaps revealed that the package could be the fiscal package could be as much as 30 trillion. Most reports I have read have suggested more in the range of 20 trillion. Either way, expectations are high, so we'll wait and see how that goes. Before then, of course, we have the FOMC and statement only this time, and we know that there's very, very unlikely to be any change in policy. It will be interesting to note whether we see a more hawkish stance now we have Brexit out the way. And I just want to share with you one article from Bloomberg just suggesting that we're not quite there yet for a hike, for a more hawkish tone from the Fed. I expect them, now we've got Brexit away and off the table, that a more hawkish tone could be applied. And if you look at the surprise index, that's the range of upside surprises versus downside surprises, and it's its highest of the year in more than a year. So just highlighting how much stronger, despite the economic uncertainty, US data has been in the past month or so. So that definitely strengthens the case for the hawks. Just looking at some of these reports, obviously we had the June non-farms report that knocked it out the park really. Retail sales, again, much better. Housing starts, housing's been very strong recently. So an ISM, manufacturing and services have all been better as well. So on the one hand, you have improving economic data, and that certainly supports the case for the Fed. But on the other hand, looking at inflation, although it is trying to recover from the 2015 lows, it still remains below the 2% target. So you could say that they've got enough cover with inflation, with the lack of inflation, to perhaps hold off for now. So I keep waiting for a more hawkish Fed to come in, and they're still remaining fairly dovish. But let's see whether, with the Brexit off the table, whether we'll get a more hawkish tone. Just looking at financial conditions have also eased. I guess it kind of comes down as to whether you think that the Fed are a markets-based Fed or an economy-based Fed. And well, from a markets point of view, you've got new all-time highs on the S&P. You've got the US dollar index. If I just get this up, you've got the US dollar index. Okay, it has rallied quite sharply from the early May lows, but it still remains below the 2015 highs. So certainly the dollar isn't quite in the position it was previously. So there's definitely some room for the dollar to go higher if we do get a hawkish surprise. A second. So just looking at the Fed's funds futures, just quickly, it's really incredible how these have moved so sharply from the start of the year. As you can see, we're pricing in just a 3.6 probability for a hike this week. Very, very much not on the cards. Just 14%, well, just 15% for September. And in fact, we don't actually see a probability of a hike until 2018, I believe. I can't seem to get any data later than that on this. But even in December, when we have the outcome of the US election out the way, you still only have a 38% probability of a hike. So definitely not on the cards. And a lot of this move higher that we've seen in US equities, I think, has been driven by that hunt for yield, the idea that the Fed are never going to hike, they've always got your back. So if there's one thing that can give us perhaps a little bit of a pause back to that 2100 level, it could be a hawkish or more hawkish tone from the Fed, saying that now that we've got Brexit out the way, now that the US economic picture is much better, and the dollar is still below the 2015 highs, perhaps there's room for a hike. So we'll see. That will be on Wednesday. Of course, just a statement only, so we're not expecting any more action, but it will be interesting whether they confirm if there's going to be one hike this year or not. So just looking finally on earnings picture, as you can see, massive week for earnings. You've got Apple, which being the big one, on Tuesday, with also you've got Caterpillar, Eli Lilly, McDonald's also on Tuesday, UK oil and gas company BP, Wednesday, Boeing and Coca-Cola, ConocoPhillips and Ford on Thursday, and ExxonMobil, among others, on Friday. But definitely all about Apple. And I've got a little preview here from this is on Celerity, which Anthony I know talked about last week. Just looking at the Apple third quarter earnings, we are expecting a decline, but look how the current street estimate has fallen. So we're now expecting consensus of $1.38 for the quarter, and that's down from $1.76, so already a fall of 20% in the past 3 months. And that's, I think, due to a lot of the speculation that smartphone sales have really fallen. So certainly interesting to note Apple earnings on Tuesday, probably the highlight of the earnings calendar for the week. Just a snapshot of earnings as a whole, you've got third quarter earnings for the S&P set to fall once again for the index as a whole, and that's quite certainly a big, well, not so important at the moment, you'd have to say, given that a lot of these, as I said before, a lot of these moves are being driven by the hunt for yield. I think that as long as earnings don't collapse, I think it's perhaps a bit too simplistic just to focus on declining earnings or faltering earnings for a bear case in US equities. I think we need more. I think a hawkish Fed, a weakening economy, and falling earnings, perhaps you could get a more bearish outlook. But I think for now, unless earnings really do start to decline dramatically, I think it's unlikely that they're going to play such a big role. But nonetheless, from a pure news flow point of view, certainly worth looking at Apple's earnings on Tuesday. In terms of today, we've got the German iPhone in about a minute's time, so I'm just going to get off the mic quickly, and we'll continue this just very quickly after the iPhone. It's right on.
10 seconds.
Oh, okay. Yeah.
Nothing seen yet from the German data. Poland comes in at 8.8, in line with expectations. 108.3 for the business climate. That's 108.3, higher than expected, 107.5. $114.7 for the current assessment, higher than expected, 114. around 102.2 for the business expectations, higher than expected 101.2. So higher for all the IFO data. I've seen an immediate blip higher in both the DAX and the FTSE as well. So DAX now moved higher to around 80 ticks higher in terms of the futures. In terms of current trading, 166.27, near the lows of the day.
So strong set of data there from the German IFO, and just watching the DAX here breaking above that 10,200 level that has capped the upside in recent trading sessions. As you can see, this is now the highest level for the month in the DAX, continuing to climb higher. Slight bid tone in the euro, but struggling to gain any traction with the 110 handle just above the high of the day. So perhaps not such a bid tone being felt in the euro, but just looking at that DAX making a nice clean break above last week's highs, and next resistance for the DAX.
Once again, as we're bearing in mind, we did just see a move higher there in the DAX.
Next big resistance I see for the DAX on a longer term time frame is that 10,500 level, which we last hit in, if I just get on the weekly. So we last hit that 10,500, that capped the upside in April, so that's the high of the year. So above there you've got the June highs and the May highs, but certainly that 10,500 for me is the next big resistance for the DAX if we can sustain this move higher today off that German IFO data that we've just seen. So the third major thing, just to quickly finish things off, the third major on the earnings, on the news front for this month, for this week, is going to be the EU stress test, bank stress test. Of course, a huge amount of interest, particularly with the Italian banks, so that should provide some clarity on the non-performing loans situation and how much the capital shortfall is for the banking sector. And just looking at the calendar for today, that German IFO, pretty much it on the whole. Nothing really for this afternoon. From a data point of view, we do have earnings from Gilead Sciences, Kimberly-Clark, Danaher, but none of the major heavy hitters. So having said that it's a massive week data-wise and earnings-wise and central bank-wise, this does look to be the day that misses out from that point of view. Just looking ahead here, you've got US services PMI, durable goods on Wednesday, impending home sales, and as well the usual Department of Energy inventories. Thursday is quiet on the data front, but then advanced GDP out of the US, second quarter, Chicago PMI, Michigan sentiment. So Friday's shaping up, when you throw the BOJ in there as well, Friday is shaping up to perhaps be the absolute pivotal day of the week. Also noting Tuesday Apple earnings and Wednesday that FOMC statement. So that's your morning wrap, guys. It's been a pleasure doing this. I don't get to do the briefing much anymore, but I wish you guys all the best for the day ahead and for the week. Thank you very much.